Hey guys, it's Joe Killinger. Welcome back to my channel. Today we're going to be talking about distressed debt, how to buy it, how we got here, and the risk involved with it. And for that, I've got Jeff Salladin. He's with Revere Capital out of Dallas, Texas, and he's a big distressed asset buyer. And so he gives us a lot of tips and tricks of the process we need to go through and what we need to watch out for. So now if you're new to the channel, my name is Joe Killinger. I've been a real estate entrepreneur for over 20 years, and I use this channel to bring on people like Jeff to really walk us through all the tips and tricks to how to be successful in real estate. So make sure you check out the video. And if you haven't done so, make sure you subscribe. Welcome back to the channel, everybody. Today we're going to be talking about distressed debt, and I've got a great guest. He's going to be our professor today. So we're going to have a distressed debt 101 class. And Jeff, thank you for coming on the show today.
Absolutely, Joe. I appreciate it. Happy Thanksgiving to you.
Thank you. Same to you. I hope you don't get too much to eat, or maybe get too much.
I probably will. I'm sure I will.
Football.
I'm sure I will.
And you're based out of
Absolutely.
Texas, right? See, I'm sure there's a couple games on.
There's a lot of football to be watched. That's very true. That's very true. But
well, Jeff, I hear every day, I'm keeping my powder dry. I want to buy distressed debt.
yeah.
I think let's start at the very, very beginning. How did we get here? What do you think was, and what do you see? Do you see a lot of distressed debt coming?
Absolutely. Absolutely. You know, when we're talking about distressed debt, I think it's important to talk about, hey, where'd all this come from, right? What's the origin story, as we like to say, as my kids like to say when they watch Marvel movies? What's the origin story behind the distressed debt environment that we're currently finding ourselves in? You know, we here in our shop have been really talking about the big three. That's what we think about: the big three of COVID, of inflation, and of rising interest rates, a rising interest rate environment, right? Those are the big three that I think have really contributed to the current banking and lending environment that we find ourselves. Because it's important to think about lenders. Lenders are just like investors, right? Investors love certainty. They don't like uncertainty. And if there's anything that, you know, nothing's contributed to uncertainty quite like those three things: COVID, inflation, and rising interest rates. And so those things are going to affect your stock portfolio. They're also going to affect a bank's real estate debt portfolio. And I promise you, I know for a fact, over the last several years, there have been many bankers who went to bed at night feeling really good about where all their loans are at, but they woke up not feeling so good about that. I mean, you know, those categories, I mean, think about it. COVID was a global shutdown. It hurt occupancies in office and retail, and you know, inflation. Eggs are more expensive for mom and pops all over the world today. Well, that same type of inflation is hitting property owners, and of course, rate hikes are negatively impacting debt coverage ratios and loan to value. So for those reasons, there's a lot of bankers out there who are, and regulators for that matter, who are concerned about the credit quality of the loans in their portfolio.
Yeah, it's you like I said earlier, you're hearing a lot. And I mean, do you see a ton of distressed debt coming down the pipeline?
Yes, we do. You know, I've been a lender for quite a while, and you know, I've got my own contacts out in the industry and in you know, various brokerage houses and various platforms, and this is a growing topic at conferences. It's a growing topic around town, and certainly, you know, we're within memory distance, so many of us, of the Great Recession, as we called it, when there was a lot of distressed debt out there. And so a lot of us who cut our teeth in that recession are gearing up for kind of another round, right? Another round in this distressed debt cycle.
What asset class are you mostly seeing this in? Is it office?
Seeing a lot of, you know, we're seeing it all over the place. I mean, a lot of office, a healthy amount of retail, actually quite a bit of land. That'll be an interesting one. We're seeing less, of course, in the industrial sector. And so, you know, you see this distress, you just have to track the regular economy, right? If people aren't going to the office as much, that's going to hurt office. If people aren't going to the store as much, that's going to hurt retail. And if people are buying a lot online, that's going to help the industrial sector. And so it just tracks the economy like so many other things. So
Yeah. Are you seeing this mostly with the smaller investors, or are you seeing some institutional people are just saying, no, we're getting rid of this?
Yeah, we're seeing it all over the place. It really depends on the factors relevant to any particular lender. Truth be told, right? And as we look at it, there's really, I tend to think of it in terms of three categories, three types of distressed debt. And the first category is what we call scratch and dent, right? Scratch and dent loans around here. A scratch and dent loan is a loan that is maybe is performing, but it might be considered distressed because of some internal factor as it relates to the lender, right? So maybe you have a bank and they're heavy on office loans, heavier than they want to be, or they're heavier on retail loans, or maybe they have a regulator that wants them to change their ratio or something like that. There's some internal reason why they would like to sell an otherwise good loan, right? We tend to call those scratch and dent loans. And so those become available. That's only because of really the type of lender, whether it's a bank or a non-bank lender, that type of thing. But that's kind of the first category of distressed loans. The second category is what we just call sub-performing loans, right? And the sub-performing loan is a loan that's cash flow positive, right? But and not LTV negative, but for some reason, maybe there's a covenant that has been blown by the borrower, or maybe there's a tenant that's going to be moving out, that's given notice that they're going to be moving out of the property, and so now the note is still performing, but just not up to the level that it was intended to. Maybe it's on the bank's watch list or something like that. That's the sub-performing category. And then the third category, which is the big one, the big daddy, that's right, is the non-performing loan category. And the non-performing loan is a loan that might not be cash flow positive. Maybe it's in a current default. Maybe there's been a covenant default. Maybe it's upside down in terms of loan to value, right? And so that's what we're seeing. We're seeing a more of the scratch and dent, a little bit less of the sub-performing, not a lot yet of the non-performing, but it's very possible that that's on the horizon. And so the volume of what we're going to see in those categories is going to depend on the lender, how they're situated. It's going to depend on the regulators, and then it's going to depend on how the economy responds to rate hikes and everything else that's going on in our nation.
Yeah. Now you guys are investing in some of these notes, right?
We have taken some positions in the sub-performing category. That is true.
Okay. How are you finding them? Just you guys have been in it a while, so people are reaching out to you, or?
Yeah, you've been around the block a couple times. You've got contacts. There are several platforms out there. There's a variety. You can pick up the phone, call your favorite commercial real estate broker. All the large brokerage shops have platforms for note acquisitions. Also, there's several online auction houses that provide venues for this type of thing. But then also, look, it never hurts just to be a banker's best friend for a variety of reasons, right? Because that banker might be looking to clear up their portfolio because of all the reasons we've discussed, and it's always good to be standing around the hoop ready to go.
Yeah, and there's one thing you scared me a little bit when you said go get your local broker, because I thought, man, which yes, that's a great way, but you got to make sure you got to weigh the risk still, right? And
That's
I think
right.
everybody just thinks distressed debt. Ooh, I'm going to go get this. It's going to be 30, 40, 50% below market value. Can you kind of outlay the risk that you guys look at when you're buying?
Absolutely. Let's talk about that. I'm glad you brought that up,
Yeah.
Joe, because it's important to think about, there's opportunities and there are risks, right? Like you said. And so let's talk about each one of those. So in these three categories, scratch and dent, sub-performing, non-performing, a scratch and dent, the opportunity all comes with the discount, right? All comes with the opportunity to buy a loan, potentially at a discount, maybe par, but the you can really tend to increase your yield when you get the discount. So a scratch and dent loan might be sold for discount, might not. You might pay 100 cents on the dollar to buy that loan if you like it. Absolutely. I'm not quoting the market, but maybe there's a 2% discount in there, a 3% discount, something like that. The sub-performing category is going to be a larger discount. Again, I'm not quoting the market. Maybe that's a 10% discount to par, something along those lines. The non-performing loan is where you're going to get the biggest bang for your buck typically. And again, we're not in a hardcore part of the cycle where we're seeing a ton of those right now. But I'm old enough to remember the Great Recession and hearing about portfolios that were a 40% discount, that type of thing to par. And so that's where the opportunity is. But to your point, there's risks on each one of these. The first thing that's important to remember is there's never, ever a substitute for good old-fashioned real estate underwriting, for knowing the tenancy, knowing the market. Amen. Knowing the market, knowing the comps, having it down cold, knowing the best operators for a particular geography. You're going to have to do that homework on every one of these. This is never going to be as simple as someone pushes a piece of paper across you and you sign on the bottom line. It's never like that. So you got to do your homework, number one. But secondly, you have to be comfortable that whatever risk the bank is trying to get rid of, that you're willing to take that on, right? Mm-hmm. And so in that scratch and dent and that sub-performing, you need to be comfortable that you can get on the phone with the borrower and work out whatever issue is there. And if you hold this to maturity, you have to be able to underwrite that and feel good about that. The non-performing space, though, that is, like we said earlier, that's the big daddy. That's the one that's going to require a lot of homework. It could be that the loan is in a geography that you're unfamiliar with, in a state you've never been to, right? Yeah. You don't know. You don't know what the foreclosure laws. It's easy to foreclose, relatively speaking, in Texas and Georgia. It's much more difficult in Illinois and New York, right? Every state's going to be California. That's absolutely right. And so you have to think all of the finance specialties, whether it's accounting, whether it's insurance, whether it's legal. All of these disciplines need to come to bear on that non-performing loan and whether you think you can get it across the finish line. And then also the important thing is it's hard to underwrite the length of time you're going to be in a non-performing loan. It's very hard. So your capital, whatever capital, whether it's your own money or someone else's money, they've got to be patient enough to wait out any of several potentialities on a particular loan. It could be that a sponsor writes a check and fixes all the problems. It could be that the sponsor never goes anywhere and this thing's going to be drawn out for several years. It's not without risk. So the premium is there, but so is the risk. It requires real expertise.
Now, do you have in-house lawyers, or how do you guys?
Yeah, no, we do have an in-house attorney. I like to say, I'm a recovering attorney myself. So I know just enough to be dangerous, but it is important to understand what your rights are in the loan docs, what the borrower's rights are. Again, foreclosure rules, traditions, all of those things are going to be unique. And so that's something you really have to do your homework on.
Yeah, you want to get boots on the ground. You want to have a good, solid attorney that you can trust with experience, because these things can bite you. You need
absolutely, absolutely, doing, so. Absolutely. It's like anything else, Joe. Nothing beats relationship.
Yeah,
nothing beats. We're in the real estate business is as they say, it's a contact sport. You need to know people, right? You need to get to know people, treat them well, understand where they're coming from, have them understand where you're coming from. That's the path forward.
Yeah. Now, do you guys buy portfolios, large portfolios, smart portfolios? I can't talk. Or you one-offs? We
can do a little bit of everything. Okay. And through the history of our firm, we have done a little bit of everything.
Okay.
Yeah. And so it's different. There are smaller shops that are going to buy kind of one-off, be very opportunistic. There are some large shops that are almost machines. They can look at 100 loans at a time or something like that. We haven't seen a lot of that just yet, but that is possible, particularly if the regulators are going to start pushing banks to move assets off. What we saw in 2010, 2011 were banks that were literally offloading hundreds of millions of dollars in loans, sometimes even billions of dollars of loans in one fell swoop. And so it can go across the spectrum. You can have a small kind of mom and pop type investor who buys loans, and you can have big institutions that are buying them as well. You get the biggest discount on the huge portfolios, I'm guessing, right? Absolutely. That's absolutely, you're basically buying in bulk is what you're doing.
And you're getting some of the good some of the terrible properties with the good ones.
You are absolutely getting them, and it's just an interesting environment to see those things. You get these loans in, and there's a handful that are going to resolve relatively quickly, and so maybe the first 6, 7, 8, 9 months, it's going to be smooth-ish sailing. You're never smooth sailing in the note buying world, but smooth-ish sailing. But then there's always going to be a tail. There's always going to be a tail, based on my experience, of assets that are going to sit around there for a while for a variety of reasons. It could be borrower based, it could be market based, and those are going to take again. They're going to take work, and it's expertise. But like I said earlier, your capital has to be patient enough to know that they may not recover for several years.
Yeah. Do you when you buy a large portfolio, you've got the terrible assets. Do you just peel them off right away and sell them, or do you hold on to them and try and turn them around as well?
That again, I've seen it done every which way, right? You have it's going to depend on the shop. You have shops that are going to go out there and are going to take down large portfolios and then immediately sell out assets they don't like. You have other big shops that are going to hold on for dear life to every single asset, and they're going to work every one of those out. It's not unlike the real estate world that we all know and love, right? You have every style of multifamily owner, every style of medical office building owner, every style, it's the same thing in the note buying world. And the style of buyer is really going to depend, on my mind, on three things: size, right? Capital, and expertise. Yeah. That's it, right? It's how big a portfolio can you look at? Are you looking at one-off deals, larger portfolios? Is your capital patient enough? And do you have the team? Do you have the expertise to pull it off?
And don't be too anxious to buy just because it looks like it's a discount. I just talked to a guy the other day. He saw this. It's a 3-spot retail, and bank is dumping it, and it's in a terrible area. Because I want to buy it. And I said, well, why do you want to buy it? Well, it's a big discount. I'm like, well, who are you going to put back in there? And he wasn't thinking. He was just thinking discount. And really got to. You've got to do your due diligence, and that's something that scares me. And this is such an important video to hear from somebody that's done it, that you need to have all of this in place before you really go out there and do it.
Joe, let me tell you what my dad told me when I was a teenager in my first job. He said, Jeff, there's no free lunches, right? You get up in the morning, you put your shoes on, you put a smile on your face, you go off and you work really, really hard. That's always the case all the time, but that's especially the case in a distressed note buying type of environment. There's no substitute for hard, good, solid, thoughtful work.
Boots on the ground. I tell you, get out there and walk that property. Know what's going on in the area. And I'm going to get a little off topic here. What do you think? Are you guys going to invest in any office? Is that something you guys are really thinking it's going to be opportunity, or maybe convert it to multifamily or housing?
Yeah, it's just, we're going to be selective, right? Yeah. It's going to be kind of market by market. I've seen some real attractive deals that are really tenant driven, where a tenant maybe 4 or 5 years ago couldn't afford to be in the class B+ or A- building that they've always wanted to be in. Yeah. And now there's an opportunity for that person to move into that market. And so I personally like tracking tenants, right? Because the tenant, they're closer to the end business. And so it's just going to be market by market. You've got supply constraints and opportunities. And so, I have read about the conversion concept of office, converting to multifamily. I'm not skeptical on that per se, but it's going to be a market by market thing. I can think of some larger metros in this country that have huge office floor plates on high rises. I don't know how you divide those up, right? And so it's going to be, it's the real estate business. It's building by building, zip code by zip code, block by block, expert by expert. And so if you've done your homework and you know who to talk to and how to kick the tires, like you said, boots on the ground, there are certainly opportunities out there. There certainly are opportunities out there, but you got to do your homework.
Yeah, and we keep coming back to that, don't we? I think we said it 3 or 4 times.
Yeah.
It's just you've got to know what you're getting into. Well, Jeff, thank you so much for your time today. I know you're getting ready to head out to your family. I appreciate it, and have a great Thanksgiving. And for those of you watching, make sure you give us a like, and if you haven't done so, make sure you subscribe. And thanks again, Jeff.
Thanks so much, Joe.